Hey there everyone, this is Michael Dougal, your Greater Toronto Area real estate resource, and for the first time in a long time, we've got some positive news, and that's the fact that the interest rates have come down once again. We've actually dropped by 50 basis points, bringing the overnight rate to 3.25%. And as of December 15th, the wait is over and we have new mortgage policies that are put into place, and these changes are happening for the first time in history, and they could really shake up the market either for the better or for the worse. That's what we're going to talk about. If you're new to the channel, consider subscribing. If you are considering buying or selling, make sure to call me, and let's get into this very first chart here where we're looking at a comparison of the monthly payments with today's interest rate versus the interest rate that we experienced for the past couple of months. So as you can see, on an $800,000 mortgage, you would now be paying $4,859.87, and this is $234.83 less than what you would have paid prior. So for every $100,000 on your mortgage payment, you'd be saving $29.35 each month on your mortgage. And you may be looking at this information thinking it's not that big of a deal. Sure, I'm saving a little bit of money compared to the prior mortgage rate, but $29 for every $100,000 spent isn't that significant. And the interest rates were 1.5% higher just back in June. So within 6 to 7 months, we've seen a pretty significant interest rate decrease. We aren't expecting to see further large rate cuts in the future. It seems most of the experts have concluded that the jumbo rate cuts of the 50-point basis drops will end, and most likely we should see softer cuts like 25 basis points, or perhaps during the next announcement taking place Wednesday, January 29th, there may not be any interest rate decrease at all. Of course, I will continue to keep you updated. Here we're taking a look at both the interest rate as well as the inflation percentage, and we're going back all the way to 2017. That vertical line represents when the pandemic happened, and we can see that the interest rates started to increase following the inflation numbers increasing, and we can see this lag between the inflation numbers as well as the interest rates, that as inflation has dropped, the interest rates have dropped along with it thereafterwards. And while there may be negativity on the news about the economy and about most individuals' financial circumstances, we can look at the positives, and that's the fact that we have lower inflation, we have lower interest rates, meaning more money for us to spend and enjoy for ourselves next year. And that also means there may potentially be more first-time homebuyers in the market. They've been almost absent recently because of the higher interest rates. Looking at this chart here, we're taking a look at the loan-to-value ratios across different types of buyers. So we have first-time buyers represented by the yellow line, as well as repeat buyers that's represented by the green lines. And we can see recently within the past few years that all three lines have pretty much dropped, which represents that people want to put less money in their mortgage, meaning that they want to have more money saved up towards their down payment. And so in this chart, we're not taking a look at the average price and how that's come down, but we're taking a look at how much money people are putting towards their down payment and how much money they're putting towards their mortgage. And we can see individuals are saving up more money towards their down payment rather than having a higher mortgage with these interest rates. And back in September, the government had announced that come December 15th, we would see a couple new mortgage policies be put into place, and these would most likely help the real estate market and help more people enter the market across different price ranges. And the first change is that we're now going to have insured mortgages up to $1.5 million before it was $1 million. And this is the first time they've changed this since 2012. And what this means in a practical sense is that we no longer need to have 20% down for the first $1 million of property that we purchase. And TD has estimated that about 20% of Canadian properties are sold between that price range, between $1 million to $1.5 million. But that's Canada as a whole. I would guess that in the Greater Toronto area, it's going to be more around 30 to 40%. So we can see just how significant this will be for the Greater Toronto area and our average price, given that our average price is somewhere above $1 million, or it has been within the past few years. This means that with these homes selling, our average price could creep higher, and it's my prediction that our average price will exceed $1.2 million next year. And the other significant change that's taking effect is that mortgage amortizations will actually extend up to 30 years. That's on insured mortgages as well as mortgages for pre-construction homes. And I think it's great that they're putting this policy into effect with pre-construction homes as well, because pre-construction homes, ever since the interest rate numbers started to increase, we've seen come down pretty significantly. But I'd love to know your thoughts on all this information in the comment section below. If you are considering buying or selling, make sure to call me. And if you're a real estate agent looking to increase your business, make sure to reach out to me to learn more about eXp Realty, understand the benefits and how the resources here can support you with building your business. Happy holidays. I appreciate your support, and I look forward to seeing you next time.